How to Turn $100 into $1 Million, Step-by-Step Guide. Hello everyone, welcome back to our channel. Today we're diving into a question that I get asked all the time. How to turn $100 into $1 million. Now before we even start, let me tell you, this isn't about some get-rich-quick scheme. This is about understanding the fundamentals of investing, being disciplined, and letting the power of compound interest work its magic over time. While it's definitely a long-term goal, turning $100 into $1 million is possible with the right approach. In this video, I'm going to break down a step-by-step guide to help you get started on your journey to $1 million. If you find this video helpful, make sure to smash that like button and subscribe to the channel for more financial tips. Let's get started. Chapter 1. Understanding the basics. Before we jump into the specific strategies, it's crucial that we're all on the same page about some basic investment principles. First off, investing is all about putting your money to work for you. Instead of letting your cash sit idly in a checking account, you're putting it into assets like stocks, bonds, or real estate with the expectation that they'll increase in value over time. Now, there are different levels of risk involved, and generally speaking, the higher the potential return, the higher the risk. That's why it's essential to diversify your investments, which we'll discuss in more detail later. The key takeaway here is that investing is a long game. It's not about timing the market or trying to get rich quick. It's about making smart, informed decisions and letting your money grow steadily over time. Remember, even small amounts invested consistently can add up to significant wealth in the long run. So don't get discouraged if you're starting with just $100. The most important thing is to start now and stay consistent. Chapter 2. The Power of Compound Interest. Let's talk about the magic of compound interest, often called the eighth wonder of the world. Albert Einstein himself even supposedly said that. Compound interest is interest earned on interest. It's like a snowball effect. As you earn interest, it gets added to your principal. Then you earn interest on the accumulated interest. This cycle repeats, leading to exponential growth. Invest $100 with a 10% return. After the first year, you'd have $110. In the second year, you'd earn on $110. This means you'd end up with $121. The longer you invest, the more powerful compounding becomes. Even a modest return can turn a small investment into a significant sum. Time is your greatest ally in investing. The earlier you start, the more time your money has to grow. Chapter 3. Risk and Reward. Finding your balance. In the world of investing, there's an undeniable link between risk and reward. Simply put, the higher the potential return on an investment, the higher the risk you're taking. This means that there's a chance you could lose some or even all of your investment. Now, this doesn't mean you should shy away from all risk. It's about finding the right balance for your personal risk tolerance. Think of it like this. If you're young and have a long time horizon before you need to access your investments, you can afford to take on more risk. You have more time to recover from any potential losses. On the other hand, if you're closer to retirement and need to access your investments sooner, you might prefer a more conservative approach with lower risk investments. It's all about finding that sweet spot between risk and reward that aligns with your financial goals and comfort level. Remember, there's no one-size-fits-all approach. It's about understanding your own risk tolerance and making informed decisions based on your individual circumstances. Let's talk about diversification, one of the most fundamental principles in investing. Diversification means spreading your money across different asset classes like stocks, bonds, and real estate. Each has its own risk and return characteristics. By diversifying, you reduce the risk of being wiped out if one performs poorly. Imagine investing all in a single stock. If it fails, you lose everything. But with a diversified portfolio, the impact is lessened. Diversification is key for managing risk and protecting your investments over time. All right, let's dive into the step-by-step guide to turning your $100 into $1 million. The first step is to establish a solid foundation. This means finding a safe and accessible place to park your initial $100 while you continue to save and learn more about investing. Don't underestimate the power of starting small. Even if it seems insignificant, that $100 is the seed of your future wealth. A high-yield savings account or a money market fund are excellent options for this initial stage. These accounts offer better interest rates than traditional checking accounts, helping your money grow a bit faster. While the returns might seem modest, remember that the goal here is to keep your money safe and liquid while you continue to educate yourself and explore other investment opportunities. As you learn more about investing and build up your savings, you can gradually move your money into higher return investments. The key takeaway here is to start small, stay consistent, and gradually increase your investment amounts as you gain more knowledge and experience. Once you've saved up a bit more money, it's time to start putting your money to work in the stock market. But don't worry, you don't need to be a Wall Street expert to get started. Index funds and exchange-traded funds, or ETFs, are a fantastic way to dip your toes into the stock market without needing to pick individual stocks. Think of index funds and ETFs like baskets of stocks that track a specific market index, like the S&P 500. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in that index. This provides instant diversification and exposes you to a broad range of companies, reducing your risk. Plus, index funds and ETFs typically have lower fees than actively managed mutual funds, meaning more of your money is working for you. The beauty of index funds and ETFs is that they're designed to match the market's performance over the long term. While they might not make you rich overnight, they offer a simple, low-cost, and effective way to grow your wealth steadily over time. Chapter 7. Step 3. Explore dividend stocks. As you become more comfortable with investing, you can start exploring other investment opportunities, like dividend stocks. Dividend stocks are stocks of companies that pay out a portion of their profits to shareholders regularly, typically every quarter. Think of it like getting paid to own a piece of a company. Investing in dividend stocks can provide you with a steady stream of passive income, which can be especially beneficial in the long run. When choosing dividend stocks, it's essential to look for companies with a solid track record of paying dividends consistently and ideally increasing those dividends over time. This indicates that the company is financially healthy and committed to rewarding its shareholders. Remember, investing in individual stocks, even dividend stocks, carries more risk than investing in diversified index funds or ETFs. It's crucial to do your research, understand the company's financials, and carefully consider whether the investment aligns with your overall investment strategy. Chapter 8. Step 4. Venture into real estate crowdfunding. Now let's talk about real estate, an asset class that's been a wealth-building tool for generations. But buying a rental property outright can be expensive, especially for those starting with limited capital. That's where real estate crowdfunding comes in. Real estate crowdfunding platforms like Fundrise or Realty Mogul have made it possible for investors to access real estate investments with relatively small amounts of money. These platforms pool money from multiple investors to purchase, manage, and eventually sell commercial or residential properties. Investors can then earn passive income through rental income and potential appreciation in the property's value. Real estate crowdfunding can be a great way to diversify your portfolio beyond stocks and bonds, while gaining exposure to the potential benefits of real estate investing. However, like any investment, it's crucial to understand the risks involved and carefully research the platforms and specific projects before investing. Chapter 9. Step 5. Invest in peer-to-peer lending. Finally, let's touch on another alternative investment option, peer-to-peer lending. P2P lending platforms like Lending Club or Prosper connect individual borrowers with investors willing to lend them money. As an investor, you can browse through loan listings, choose loans based on your risk tolerance, and earn interest payments as borrowers repay their loans. P2P lending can be an attractive option for investors looking for potentially higher returns than traditional fixed-income investments. However, it's important to remember that P2P lending carries its own set of risks. Borrowers on these platforms may have varying creditworthiness, and there's always the risk of default. It's crucial to diversify your P2P lending investments across multiple loans to mitigate risk. Before investing in P2P lending, thoroughly research different platforms, understand the risks involved, and carefully consider whether this investment aligns with your overall financial goals and risk tolerance. Start investing today for a brighter financial future. So there you have it, a step-by-step guide to potentially turning $100 into $1 million. Remember, investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. While there are no guarantees in the world of investing, by following these steps, consistently investing and letting the power of compound interest work its magic, you can significantly increase your chances of achieving your financial goals. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more personal finance and investing tips. And be sure to let me know in the comments what other financial topics you'd like me to cover in future videos. Thanks for watching.